In Thailand, economists track national health using a very specific barometer, the Mama Noodles Index. Instead of relying solely on industrial output or high-frequency trading data, analysts monitor the sales of these 50-cent packets to predict when the country is entering a recession. The index relies on a consistent anomaly. When sales of Mama Noodles spike, it's a reliable signal that national incomes are falling. This creates a contradiction in the standard logic of commerce. Usually, a product becomes less popular when the population has less money to spend. Yet for ramen, the opposite is true. We can find the answer by mapping out the invisible laws that dictate the price and availability of every single item in the global market. In economics, a market encompasses any physical or virtual location where buyers and sellers trade goods, from an outdoor food stall in Bangkok to a global stock exchange. To understand how these markets function, we look at the buyer's perspective, known as demand. Imagine you're walking into a store specifically to buy a smartphone. This chart shows the law of demand. It's a simple relationship. The lower the price, the higher the quantity consumers purchase. We distinguish between a movement along that line, like buying on sale, and a complete shift of the line itself due to other factors. These shifts are driven by non-price determinants, like changes in consumer preferences, the cost of substitute goods, or the price of calling plans. This explains the ramen paradox. A recession causes a widespread drop in income, which acts as an external force. This shifts consumer demand away from expensive meals and toward cheaper alternatives like instant noodles, causing sales to climb even as bank accounts shrink. Now we look at the sellers. The law of supply states that producers are willing to sell more when the market price is high, resulting in an upward-sloping curve. This curve also shifts based on external factors. If a new competitor enters the market or production technology improves at a factory, the total supply of phones increases at every price level. Problems arise when buyers and sellers don't align. If a seller sets a price too low, they trigger a shortage, where quantity demanded far exceeds the amount available on shelves. If the price is set too high, the market faces a surplus. Unpurchased products sit idle because the cost has outpaced what consumers are willing to pay. These imbalances are systemic incentives. They force buyers and sellers to adjust their behaviors until the market can stabilize. When we pull these forces together, we find equilibrium, the point where quantity supplied matches quantity demanded. While markets fluctuate, pressure from shortages and surpluses acts like a gravity well, pulling prices to this stable intersection. Every price on a shelf represents a real-time negotiation between millions of different buyers and sellers. This logic applies whether you are looking at the launch price of a new flagship smartphone or simply scanning the refrigerator case for the cheapest brand of margarine. A price tag is a map of human psychology and behavior, expressed in dollars and cents.